Welcome to Sisters Conversations Podcast with your hostess, Latrice Carter. We feature interviews in literary, film, and television, as well as real topics that impact the Black community.
All right, welcome to Sisters Conversations with Latrice Carter and my co-host, attorney PIllara Henderson-Smith. Today's show, we will focus on trust, and we will be talking with a special guest expert, Juliet Marie McElwee, about life insurance. Welcome to Sisters Conversations. Hey, PIllara.
Hi, Latrice. And welcome, Juliet. So today we are going to dive into trust after we learn from our special guest, Juliet, some different types of life insurance, why it's beneficial to have life insurance, and how do we exactly get life insurance. All right. So Juliet, she is an independent insurance broker, and she's committed to helping individuals protect what matters most. She's a former advertising account manager and stay-at-home mom. She began her journey as a life insurance broker in 2015 and then quickly branched into an area of Medicare and senior health products. It's her passion to educate and prepare individuals to make their best decisions, prioritize listening to her clients' needs, and preparing completely what options best serve their needs. Senior group and community seminars are her specialty. Welcome, Juliet.
Thanks so much for having me. Thanks, PIllara, and thanks, Latrice. I appreciate the opportunity.
Oh, you are so welcome. We're glad to have you on the show. This is a very important topic, I believe, especially in the Black community. It really is. So for all of our listeners listening, tuning in, we want to make sure that we equip you all with valuable information today about life insurance and trust. So grab your notepad and a pen and make sure you take some good notes. We will be dropping Juliet's information in our podcast group, as well as we will share her information on Sisters Place page on Facebook and Twitter, as well as something new that I just started doing. Starting next week, we'll have a short blog for every YouTube video, because this is also posted on YouTube automatically. So it'll be a short write-up for all of our podcasts, and then it will include the YouTube video. So we will drop that, so it will be forever out there. It goes out to all of our newsletter holders. There's over 275 people on our newsletter list, and I'm super excited about that. So they'll get this information as well. So we're going to kick it off and jump right into our interview.
All right, Juliet. So we're just going to start from the very beginning and the very basics, assuming that we all know nothing. All right. So what's the difference between term insurance, whole life insurance, universal whole life? What does all that mean?
Absolutely. So term insurance is basically coverage providing a death benefit payout only when the policyholder dies during the term of the policy. And that can be anywhere from 1 year to 40 years, depending on the term. This is the most widely purchased insurance because it's affordable. It's usually much cheaper the younger you are. So, and the more insurance you need, it's actually cheaper than the other types that you mentioned earlier. There is no cash or accumulating value with term insurance. So once the term is up, it's over and there's nothing left. So you're just protecting your assets during that time period that is set. When you're talking about whole or permanent life insurance, that provides coverage upon death at any point, as long as you paid those premiums, right? It's available for ages 0 to 85 in many different varieties and flavors of coverage. There's traditional whole life, there's children's whole life policies. You might see some of the companies that offer that for little ones. Seniors get those final expense policies where they're either graded benefit or simplified issue. They're designed to have a fixed or same premium throughout the course of the policy for the life of the policy. So you're always paying the same premium every year, whatever term that is, monthly, quarterly. And they're designed to have an accumulation feature, which means basically that over time, and it's an extended period of time using compound interest, these whole life policies gain cash value, which allows the insured during the time of their life, while they're still living, to maybe access a portion of their funds tax-free. When you're talking about universal life insurance, it's very similar to whole life in that they're designed to last your whole life. And you do get the tax-deferred growth, just like a whole life policy. But these are a little bit more flexible with the premium amounts. So you're required to pay the minimum or the policy will lapse, but the potential for them to grow and gain cash value depends on the specifics and how you've had that policy set up. If it's set up well, there's a minimum guaranteed interest rate on a universal life policy. And if the company earns more than that minimum, that excess is credited to your account as interest, right? And that increases the value of what you have, okay? It's far less expensive than a whole life policy, and it's flexible, right? So you can, down the line, if you don't need the death benefit to be as high and you want to lower your monthly premium, you might have the option with some plans to do that. You don't have that option with a whole life policy. And also the UL, Universal Life, that's also called UL, they're lower than whole life when the interest rates are high. So that's a little bit in a nutshell of the different types of life insurance that someone can buy.
I have a question.
Sure.
Variable life insurance policy.
Mm-hmm.
I think that's the one I have, I believe. Got it when I was 26 and it locked in at that age. That price has never changed. It has cash value. I selected several different mutual funds that invest in it. Is that similar to, what is it, Universal?
Very similar to Universal. There is what's called fixed universal and there's variable universal. So there's many different flavors of universal life within that one category. Yours is tied to the stock market. So when the stock market is performing well, that interest rate flies up and you are credited accordingly.
Okay, nice to know.
Some great information there.
It is.
So term insurance is for a limited amount of time. And then I heard you say that some of them is from like birth to age 85. So I'm wondering, is there a particular age that you would recommend the different types of insurance?
Sure. So with whole life, you can get a policy from birth to age 85 in many cases, and it's designed to last your whole life. So it can go up to depending on the maturity for each company, it might be 100 or 102 or 120. So the stages, life insurance really requires customization and personalization. And insurance companies look at different factors to determine how much you're going to pay for your coverage, right? They look at your health history. They look at your age. They look at your gender. And so the younger you are and the healthier you are, the lower your insurance costs are going to be. So for each individual, I wouldn't say there's a specific time that I would recommend each category, but whole life for children is fantastic because it's very inexpensive and paid over the length of the policy, the life of someone. It will gain cash value, right? And it's very inexpensive. So someone can get a policy for a newborn for, $5, $7 a month, and you continue paying that $7 a month for whatever amount of insurance you're purchasing, it will gain some cash value. Term insurance is a very cost-effective way to cover your debts, your mortgage, your expenses. So I recommend anybody who is having a major life change, starting a family, buying their first property, refinancing their home, to look into making sure that they have enough insurance to cover their expenses in case they lose, in case they pass away, right? Because they don't want their spouse to have to recoup income, right? Possibly, paying off that mortgage, making sure that their children can go to college, all of those expenses. So term is a very inexpensive way to buy a large amount of coverage to cover you for the time period, especially when you're young and married or young with children, to be able to cover your expenses in that time. Does that make sense?
It makes complete sense. Yeah.
Great. Mm-hmm. And for universal life, again, it is more expensive than term, right? Because it's built to last longer. So the younger you are, that's the best time to get it. If you are 18 and you are going into college and you don't have a lot of money, you can still get a universal life policy with a small death benefit that is designed properly to grow as your needs grow, right? So down the line, you can maybe put more money into it and have a higher death benefit. Mm-hmm. I like that because you don't know what you don't know, right? So if your health changes when you're 25, mm-hmm. right? And you are, God forbid, having a chronic illness or a catastrophic situation, you're uninsurable with most insurance companies. Mm-hmm. Then you have nothing. And I find a lot of people that get into that situation. We don't know what we don't know. And we hope that we're going to get to some situation where we can buy those big and sexy, insurance policies. But really the best advice to do is to buy what you can while you can. Just start where you are.
That makes so much sense. So it sounds very similar to estate planning in that people don't realize they need it until it's too late, mm-hmm. right? And mm-hmm. once you have a chronic disease, then you're not eligible anymore. Once you need those powers of attorney or a will or whatever, it's too late. The person doesn't have capacity or the person has passed away. So it sounds very similar to that.
Yes.
That's a lot of good information in figuring out exactly those things, and especially with the term insurance, to think of that as, that kind of that umbrella, that safety net for you when catastrophic things happen, and then it's there to help put you back at an even plane and maybe even hopefully give you a little step up in there.
Absolutely. And all policies are not the same. Every company is different, right? So that's why I chose to get into this business and become a broker, because I work with a group that gives me as many carriers in my portfolio so that I can match people up with what works for them. Mm-hmm. So if you call a 1-800 number and say, I want term, or I want whole, or I want universal life, they can maybe offer you those, but you're only going to get what they have in their bag, right? Mm-hmm. With their terms, right? Under their underwriting guidelines, and they differ from carrier to carrier. Some people may not take someone who's a certain height and weight, where another company may say, oh, we'll take them at a standard rating for that height and weight, where somebody else might be declined.
Mm-hmm. That's
right.
Great to know.
So as a broker, I have many tools in my bag to be able to say, let's look at these factors, look at their health history. Do they take somebody who has diabetes? Do they take someone who, has, smokes? Smoking makes a difference if you smoke or not. So it's all companies are not created the same way. They're not all structured the same way. So it's good to know someone who can look at the different carriers and differentiate what your needs might be.
I have a question before you move on. So I'm a breast cancer survivor, right? If I wanted to get another policy, would I go route term? Would I not be eligible?
Well, it depends on any of those would work for you, depending on the carrier, right? Because some may say, we won't take anybody with any history of cancer. They may say it's got to be 5 years between your last cancer treatment, or they will check your prescription drug history to make sure you're not taking, medication, for that condition. So it really depends on the carrier and how long you have been cancer free, right?
Okay.
So it's just kind of knowing the underwriting guidelines in that situation, right?
Okay. So I finished treatment in January this year for the left.
Congratulations.
So thank you. I wouldn't be eligible for any additional life insurance until 5 years later.
In some cases. Some cases. Yes, ma'am. Okay. It really depends on the carrier. Everyone is different. So, and what I find with a lot of people that I see, they'll say, I called this company or somebody came out and they told me I couldn't get insurance, right? And that may be the case with that company, but to know that maybe there's a policy that has a different kind of underwriting guideline. There might be one that says, hey, we'll take you, but you have to live 2 years before we'll pay anything out. There are policies that say, well, you know what, you'll pay a little bit more premium monthly to get the coverage that you're looking for, right? And then there's some that are just going to be a simple decline based on a variety of factors, right? Somebody who has a breast cancer history and a heart attack, history of heart attacks and has, diabetes, and, they've got the trifecta of a lot of things going on. And that's a little harder for me to find somebody coverage, but it's not impossible. So we just need to do our homework.
Okay. So when you say history, do you mean that person or their family history?
That's a good question too. Every carrier is different. So some companies will ask you, did your mother have breast cancer? Did your father have cancer? How old were they when they died? Are they still living? Or, how old did they die of that condition? And some companies don't ask that at all, and they just go based on your health history. So it is essential. When I meet with an average client, I sit with them and go through everything. I want to know all the questions. I want to know about their health. I want to know, hey, are your parents still living? I want to know those things because then it will help me go through my tool and tricks to find the company that's going to give them the best possible rating.
Wow. Yes. It is very custom, very unique. Every policy sounds different and every individual is different. And
absolutely.
So it's really important, it seems like, to get with a person that you trust and that's really going to be an advocate for you and helping to find what actually works for you.
Yes.
This is such invaluable information, Juliet. So glad you're with us.
Yes.
So you have mentioned cash value a few different times. So some of these policies have cash value, particularly when Latrice asked you about her variable policy, and you said her own was tied to the stock market. So explain a little bit about the cash value. So how does that work? Is it off of, the face value of some of the policies, the premium, what exactly is that and how does that grow?
Awesome. Great question. So cash value or accumulation is basically the amount of money that you would receive if you surrendered the policy, right? So when you pay a premium, part of that money goes to the cost of the insurance, like funding your death benefit, right? Funding that coverage amount. Part of it goes to operating expenses and fees of the company. And another portion goes to cash value, which is basically, think of it this way, an account inside the policy, right? And there's interest attributed to that policy depending on the company, depending on the policy, and it grows over time using compound interest, right? In Latrice's case, hers is tied to the stock market. So when the stock market goes up, so does her policy, so does her cash value. She gets a certain percentage as the variable policy fluctuates. With others, there's a guaranteed interest rate, and anytime the company performs above that interest rate, then that excess is credited to you as well. Okay, so that's a little bit about how cash value works. You can use it over time, right? And I say over time because I get a lot of people who go, how much money is in my policy? And we call the company and we find out how much is in there. And there's, a couple $1,000 or, very little in there, and they want to take it out. And really it takes more than 10 years for a policy to start gaining its legs and getting that cash value to accumulate and compound.
Okay, so 10 years. So that's kind of leads me into my next question then, because 10 years, that's a pretty broad amount of time. And I know some of our listeners have probably heard, it's really great to have these policies because then you can loan money to yourself. And so you can borrow from that cash value. But it seems like what you have to know, though, is like this is a long-term down the road type of a thing that you're not going to be borrowing tomorrow. And do you even think that that's a good idea for people to even do that?
That's a great question. So borrowing against the cash value is something you should always discuss with your provider, your insurance company, giving them a call. There's somebody in their member services that can actually run what's called an illustration and show you what's there. Because when you get your initial policy, you'll get a booklet with estimated values of how things are going to play out over time. If you pay a certain amount of premium over time, this is what we're hoping that you'll see as a return. But if you call the company, they'll tell you what's in there, how it's working, how it's performing, and discussing what your needs are. The best time to access your cash value is when it is significant, right? And it's never under 10 years, in my personal opinion, what I'm seeing. And also if you don't need the death benefit. So let's say you don't have, a lot of children, or you don't have any children, or you have significant assets over time that have grown and you don't need that big death benefit, right? And there's a lot of cash value there. You might want to pull from that value, right? And put towards your grandkids' education, or you might want to pay off something from that cash value. If you have one way that is, what's nice about cash value for people who are older or who maybe are out of work, you don't have to show proof of income. Basically, it's like a loan. You're taking a loan from the company and using the cash value as collateral. You're really not taking that money. You're actually borrowing from the insurance company, and your cash value is the collateral. And there is the interest is very low on those type of loans. So if you don't have a job, or if your credit is poor, or if you need the money very quickly while you're maybe waiting for another loan to come through somewhere else, that is a great way to get money fast.
Okay. All right. So
Done
there's
that.
different factors in there. Latrice, you had something? Go ahead.
I've done that. My policy, that one I've had, it's been, oh my God, the cash value has grown over 20 some years. I got it. I said I locked it in when I was 25 and I was 46, out of work, have a child, and I needed a tuition bill had to be paid, and unemployment wasn't going to cover it. And I actually did pull from that to help pay for my daughter's college education.
Absolutely. It's a great tool to be able to use that way, but also just keeping in mind that you pay the annual interest on that loan, right? And it compounds over time. So if you have the loan outstanding for a long time, you will be paying a lot extra for that. Does that make sense?
Yep.
And if you don't pay it directly, they will pull it from the death benefit.
Yep.
So if your death benefit is, $500,000 and you're borrowing from that policy, over time, that will decrease that death benefit. So you always want to be careful that if you don't have a significant cash value with like a consistent interest rate, earning interest over time, you've got to keep track of that. In your case, Latrice, it sounds like you had a large cash value.
Oh, very large.
Interest rate is doing very well. Yeah, that's wonderful. The interest rate is doing well on there. So you can keep your coverage in place, for a long time without having to pay, additional funds, right? But somebody who, maybe let's say they lose their job, they want to keep their insurance. they may not even have to pay the monthly premiums for a while, for a short time, because the cash
can
value
pay it.
will pay that premium.
So it sounds like if you have significant assets and you don't really need it, it might be a good idea to pull out, because that's kind of an easy, quick way to get funds. And it also sounds like if you need emergency funds, that it's a good time to use it, right? So those are like maybe two good scenarios. And if not, you should leave it alone and let it do what it's supposed to do.
That is in most cases. But when you get to the age of, many people are using it as a method to get tax-free retirement, right? So certain policies, not all, and we're not talking like traditional, whole, we're really talking about some that are more on the investment side of insurance, that they're designed to, at a certain point, be able to give the benefit, give the insured money, they can draw from that money tax-free.
Oh, wow.
Right? And so that pulls and brings the death benefit down every time they take. But imagine a senior. Can you imagine how many seniors that maybe would have started that when they were in their 20s and 30s, and now they're in their 60s with maybe a lower Social Security, to have a little extra income, $1,000 or $500 a month, that might make a really significant difference. It will draw down on the cash value, but if you designed it correctly, it will you'll still have something, and that's worthwhile.
But that's wonderful, because if you are a senior and you're older, you're not necessarily trying to leave benefits behind to make sure everyday needs and comforts are taken care of. You're leaving extra behind. And so with that, you're able to make sure that your quality of life is still well at a time where you're not able, maybe not necessarily to work for yourself and earn extra income, but you've been smart while you were earning.
Absolutely. But then those policies are not designed for the older people to get, because it's not going to build anything. It's for the young people.
Yeah. Okay.
When you get out of college and you have a job, you need something that's going to grow in addition to your other sources of investment.
So you have to be smart early on in order to use that later in life. All right. So all of our under 30s, she's talking to you. Okay? So write a note. This is what you need to do. Now, I come across a lot of clients who have insurance policies, or someone else has had an insurance policy, and they don't know the details the way that they should. And they'll say, well, the cash value has been paying the premium and we think it's still okay, but we don't really know what's in there and not. So is that a good idea to allow the cash value to pay the premiums, and how should they monitor that?
Great. Situations vary from person to person. The simple answer is not long-term.
Okay.
So if you have a large cash value, like we mentioned before, with a significant interest rate, you can call your insurance company and find out how it's performing. You can often keep your coverage for many years without even having to pay anything, right? But with many policies, and that's in a lot of cases, when you have a low cash value, or when the interest rates are not performing as projected, you've got to watch it, because the policy will lapse because there's not enough money in there to sustain the cost of having the insurance.
Which is what I've run into a few times with clients. And that's always a scary thing, which is why I wonder, is this even a good practice to allow that to happen, to just allow the premium, because you're going to get, I don't want to say you get lazy about it, but you use the default, right? So you don't take as much care and look into it as much as you should, because there's that assumption that the cash value is taken care of.
Absolutely. And what you can do is call your insurer and ask them, is there anything that I can do to reduce, right, the death benefit, or reduce my premium on this policy? And that they might be able to work with you on that, depending on the type of policy that you have.
That's really good information for me to give clients. And I never thought about that, to actually even call the insurer and to ask if there's a possibility of reducing.
Making some adjustments to the terms of the policy. And that's why the UL is nice, because it does give you that flexibility.
That's really great. So on this podcast, we really love to speak directly to the Black community. And so one of the questions we are really wondering is, do you have any idea of like what the ratio is of Black families that actually have insurance or enough insurance? Maybe,
Well,
I know
let's put it this way. There was a study done, a survey done a couple of years ago by an insurance company called Haven Life, and they mentioned that 22% of Black families value life insurance, greatly value life insurance to pass on for generational wealth. Like they love the idea of getting life insurance to pass it on for the next generation, right?
Because that's a low number though.
Only 22%.
22%.
Okay. So, but the average life insurance value benefit with African American individuals is only $50,000 as compared to the average white family in America, which is well over 200.
Wow. So 22% of us, and it's 50,000 or lower. And I would say a lot of the seniors that I've come across is even smaller than that. It's usually like a 10,000 and they're only thinking in terms of burial.
Yes. Correct. Because there's a history of that comes with our wonderful history, right? Where since the 1800s, you know, we have been approached to purchase small amounts of insurance to cover our, you know, our burials, right? And for high premiums.
Yes.
For high premiums.
Very high.
And so that has been that's in our history. That's in our history. But 70% of the wealth transfer in this country is based on life insurance.
Wow.
Somebody somewhere passed away. Somebody's grandfather passed away and left his kids enough money to send their kids to college. And you want to know why in these neighborhoods we look and go, how did they do that? How did they buy cars? How are they sending their kids to college? How are they paying for these weddings? It's because somebody had the thought to invest in their life insurance when they were young. And instead, we have people coming to the elderly in our community saying, before you die, you need insurance. And this is how much it's going to cost. So it's more expensive when you're older, and it's very expensive when you're sick. And sometimes it doesn't even pay out at all because it has terms that you have to have a certain amount of coverage. And because it's expensive, and because a lot of our community lives on fixed incomes, right? Then they end up lapsing because it's too expensive. Right. It becomes unaffordable. So as young as you can get it, the better you are.
Those numbers are staggering. It's staggering. So 70% of the wealth is there. We're only
22%.
It's even worth doing it, but that doesn't even mean that 20% have it. It just means that 20% says that it's a good idea.
Absolutely. Right. And if you look, one of the things that I get with a lot of my clients is they'll say, I have insurance through work. I have insurance through my job, which is fantastic. I love workplace insurance because that's called group, right? You're part of a group and a pool. They don't help qualify you. So if you have, disqualifying conditions, that's a great place to get insurance for a very affordable price, right? But anyhow, you're not part of a company that's going to really set you up. Usually some of the larger ones, you lose that insurance when you leave the group. So when my husband lost his job years ago and we had, 5 times his salary, we no longer had that anymore. And we only had a small amount, right? We had to go looking for something, right? And if you have health challenges, if you have other needs, you can be in trouble. And usually that's why people end up looking for those final expense policies when they're older.
Wow. I think a lot of people don't realize that too, that once they leave that company, that insurance no longer exists for them. And so that's
in many cases.
Yes.
Piggybacking off of that, So our company offers that same insurance, and I think mine is like 3 times my salary. They also offer additional. You can purchase additional coverage at an additional cost. The company pays the first 3 times your salary. They do offer you that opportunity to purchase additional. Mm-hmm. I think that's the part. If you purchase additional on your own, that will go with you if you leave. Is that something you think I should consider, given I'm in that high risk now? I always pass on it, and I just let them cover me.
And it depends on how much you want and what it costs. But since at this point, you don't have another option, if you want insurance and they will cover you, absolutely. Absolutely. However, and that's great if you can purchase it for a reasonable amount. When you leave the group, they might give you the option of paying the non-group rate to keep that insurance. And that's usually astronomical.
Yeah. I plan to retire there, so
there you go.
That's good.
Okay.
But even when you retire, usually when you retire, you're not getting that anymore unless the company has something set in place for that. Right. It's very rare.
It is very good. And I'm always telling people, okay, you know that policy don't follow you from work.
They don't. They really don't. And it's important. I really, I think that when we talk to our communities of color and we are looking to encourage families to set themselves up for, what's unknown, life insurance is a very important part of it. I have seen young families in their 30s, lose a parent, lose a spouse. They have young children. They have a home, and they've got to uproot everything because they didn't have the coverage in place. And, $100 here, $200 there. And really the costs depend on your health and your age and all of those factors. So the younger you are, just to protect yourself, just to protect your future, just to give your kids a leg up, make sure your wife doesn't have to, sell the house or go through anything other than just grieving you, allowing you to grieve with some peace. Yeah. That's what life insurance can do.
Yep. I have a lot of family members, we were having a conversation. They don't have life insurance. I was like, okay, do you at least have the burial? Do you at least, that's like the cheapest you can get. Nope. And I looked at my cousin and I was like, I don't know who's going to pay the burial. Y'all going to do a GoFundMe.
Well, you see a lot of the GoFundMes and you see a lot of that pass in the hat, which everybody does, that's very popular in our community. That's why people send cards with $20 here and $50 there because they know that it costs something to bury. And listen, let's just be honest. We don't have step when it comes to a funeral. We are people that celebrate the homegoings, right? And the average funeral cost, depending on the type of funeral and where can be anywhere from $8,000 to $25,000. So why pay dollar for dollar for something where you could pay pennies on the dollar from the start?
Absolutely.
It's so important.
Absolutely. A coworker, she lost her father, and they were going through his things, and they're finding policy after policy after policy. They found 6 policies, and mind you, he got these when he was very young, and her mom is set. They're set. The grandkids are set. And, at first, we were all joking about it. And I was like, you should have multiple policies, and he had different, he's literally had one of each of these. And they were hidden all over the house. He had dementia, and he had literally hid policies, hid cash all over the house. They were literally, they stopped people from coming in because we're going to the closet in suit jackets. He got $200 in this jacket, $300 in this jacket. They found a bag of money up under the mattress, sewed into the mattress.
Wow.
And that's not including the bank accounts.
Well, you know what? That just goes into my process of how I like to help people, secure insurance. When you are buying insurance, I recommend that you ladder your coverage. So you get, I look down and say, hey, let's look at our expenses. Let's look at what you're trying to achieve. What if you left tomorrow, what would be left for your loved ones? What would you want to do? Would you want to pay for college expenses? Would you want to pay for, the mortgage off, the house off, whatever those things might be.
Right.
And then we figure out how much term to purchase at that time to cover those things, based on, those needs. And then we look at something that we can afford to keep forever. So it's never going to be that huge, big and sexy, I got $1 million here and I got that. And I can do that. I'm well equipped to do that. But let's start where we are. If I want to make sure I have $100,000 to leave to my family when I'm, 100 years old and it's there and it's paid for and it's a reasonable price, then that's what I want to have, and have enough term that may expire when my house is already paid off and my bills are paid and I'm retired and I don't need to worry about those things. So just kind of managing and laddering those things. Children's policies are fantastic because they gain that value over time. So after a very long time, you might be able to use that money to help your grandchildren, right? Or if your child is unhealthy or has a problem, then they have guaranteed life insurance that's covered at a very, very small premium monthly.
Okay. No, very good information. What are some of the benefits of purchasing life insurance for children? I mean, I know this is perfect segue into that whole conversation. I know you said college fund, and I'm sure a lot of other.
Sure. So the basic final expense protection, right? If you lose a child, you're going to, you don't want the headache of trying to come up with those funds to handle, a burial. Nobody wants to bury their own children, but some people have to, right? So just to cover what that would be, the cost of a home, casket, graves, whatever you're doing. Also, if you are planning, you don't know what you don't know. So if you get insurance for them later on, if they become uninsurable, have a diagnosis that they can't get coverage, you have something there at a low price, as well as for cash accumulation later on. Many families think, oh, wow, it's too late for me to start getting into this whole insurance thing. I've gotten older and I don't know what to do. It may not benefit your kid. Like for me, my parents didn't have that way. I started a little bit later, right? I learned later, but it won't benefit my kids as much, but it'll benefit my grandkids.
Right.
I'll have something to be able to say to my kids, here's a little bit of less burden for your kids to go to college. I'm going to have something for them.
Very nice. Is there a cap on the value of it? Well, yeah, the life that you can get for kids. So like, is it like a 30,000, 50,000? Like, what does that look like?
It depends on the company. They're anywhere from 5 to 40. I've seen 40 up to 50,000 on some children. So you can get that. With some children, if you're just under 18, like a teenage age, I think it's 15 to 18, you can get a universal life policy that has the potential to grow. So it has a low cash value. It has a low death benefit value, but it will increase as you want it to increase. So later on, the child has the flexibility to put more money into it, and then the death benefit increases.
Okay. I have a life insurance policy on my daughter. It's a whole life policy. I got it when she was 16. Locked right into that, locked it right in. It's like $300 for the whole year.
Right.
Really
it's
simple.
worth it.
Mm-hmm.
It's worth it.
No, I see a
Down
lot
the
of
line,
the
when she gets older and she gets a job, she needs to get her own. When she has a house, she needs her own.
yes, she'll be
And you,
30.
as long
We're
as you
working on
keep
that now.
as long as, and you have the option of keep paying that $300 a year and hang on to it, and you're the owner of that policy, and
Yep.
you can transfer it over to her at some point if you want, or she can have the option of cashing out that money down the line for her child or for her future or something she would like to do.
Okay. What about the Gerber life insurance policies? I see those. I'm getting ready to be a grandma, a nana later this year, well, in October. They have, I get a lot of the in the mail, promos in the mail, up to 50,000 that you can purchase for your grandkids. And then when they turn 18, they could add another 50 or 100,000 to that.
Yeah, there's some policies that double when they get to a certain age. That's the Gerber grow up policy. And I mean, there's nothing wrong with any of those. You know, I have the ability to actually, you know, I'm contracted with Gerber, and I'm contracted with a couple other companies that offer children's whole life policies. So we can look at those and see, hey, which one is going to be the one that's going to give the best bang for our buck. So lots of options. Gerber is very popular, so everybody runs to them, which they're great. But there are also other options out there, and the rates differ from state to state.
Okay. Very nice to know. Very nice. It leads me to my next question. Do you recommend purchasing a separate policy for your child or adding a rider to your current policy for your child?
Good question. So if your child has an illness, like if they have, you know, a disorder or something going on, you know, a rider would work to cover them in case something, you know, happens to them. But I think it's my mindset that separate is best, right? And if you can't afford it, it's great. It's cheaper to add them on as a rider for a short time, and that's a great idea. But if you can afford it, separate is best, because if something happens to you, that policy is done.
Okay.
Yeah, and now they're not insured.
And then they're uninsured.
Gotcha. Okay. I did good getting her a policy when she was 16.
Good job, Mama.
Okay, very good. What type of insurance policies would you recommend for purchasing for a child?
Child life or universal?
Child life or universal. Okay. All those parents and expecting parents out there. Is there annuity insurance?
An annuity is an insurance contract. It provides a safeguard for your funds or your assets with an interest, right? It's just a way to protect your money, your income from the volatility of the market, and it can offer a guaranteed income stream. So if you want to turn it on and annuitize it, right, when you'll get a guaranteed amount for that from that account. When you pass away, the value of that policy is transferred to your beneficiaries.
Oh, okay. Very nice. What are some pros and cons of an annuity versus traditional insurance?
Well, properly set up, both of them can be set up to invest and access money tax deferred. So that's a good thing, right? In a life insurance policy, you pay a premium monthly, right, that pays your beneficiaries when you pass away. In an annuity, you pay money up, your upfront money is invested, you know, depending on the terms of the company or the product that you've selected. And there's a guaranteed interest rate and often a cap at how high that interest can go, right? So the upside is when you're retired and you need to be more conservative with your funds, you won't lose a lot of money, right? You know, when you're in the market with your 401k and your IRAs, you're subject to the volatility of how the market is going. But an annuity, you don't have that. You don't hit the highs and lows so hard. But the downside is you won't receive the highs, right? You're capped out, and you're not gonna see those high gains of the market if that happens. With an annuity, you also have the flexibility. You don't really have to annuitize it. You can take a percentage of your funds that are invested in there tax-free, not tax-free, but you can take it out, a percentage out every year without penalty. And the downside is if you need access to that money before you turn 59 and a half, which is the time that you are required to take your investment, you're able to access your qualified investment, you will pay penalty to do that, and that can be very expensive.
Wow. Okay. Oh, wow. So overall, is life insurance expensive and is the price locked in at the age when you first purchase it?
In a whole life policy, it is locked in. So you'll pay the same amount, whatever, for as long as you have the policy. In a term policy, you'll pay according to the subject to the term. Some have an increasing term every single year. The amount goes up. And you might notice that like in your workplace plan, you have a workplace insurance, and one year it's, $30 a month, and the next year it's $40 a month, So some, depending on the terms. How expensive it's really depending on the company. Every company is different. Your age, your health, your medications that you take, right? All of that factors in to your insurance. Even your driver's license, your driver's history. So if you've got a history of, a lot of, violations and things like that,
oh, wow,
that will show up. Many companies will do, when they do underwriting, which is the review of your insurability, right? They will look at all of those things. They will look at your driver's license history. If you have, DUIs and things like that on there, that will affect your ability to get coverage. So, or the price that you pay.
Does your credit affect your ability to get insurance or not?
No.
That's unusual. Your driver's license, I wouldn't have thought of that. Is there anything else that's unusual that people wouldn't really think about that might affect whether or not you would get insurance?
So that's a really good question. I would think, well, yes, driver's license, that's a big one, like your driver's history. Yeah. I actually had a client that was applying for long-term care and got denied because he had something on his record for alcohol abuse.
Oh, wow.
Oh,
so
wow.
So if you, they'll look at that and go, oh, you have a history of drug use, or, I have one that I actually went to their house and I was like, oh, so do you smoke? And they were like, no, I don't smoke. I'm like, do you smoke pot? And they were like, well, I didn't smoke it today, and I was like, well, when was the last time? Because, right, when they interview you and do your, set you up, the best prices you will get for life insurance is through underwriting, meaning somebody is going to take your blood, easy, little prick, don't be afraid, urine, right? And they are going to ask you a bunch of health questions, and then they're going to check your prescription drug history and your driver's license and all that stuff. Yeah. And they will give you the best. That's where you're going to get the best rating, right? So somebody who is smoking, pot, and they might be like, well, when's the last time you smoked it? And they've got that in their history, or they've got it in their urine or something. They might get pay a higher rate, yeah, or be denied depending on the company.
Wow.
All right. Those little things.
The more you know.
Yes.
Oh my goodness. This was very informative and very helpful. Oh my God. I'm gonna have to go back and like listen to this to write my notes. so that I can create a newsletter and send it to just the family members
Just send me their way. We can do it.
I'll put your information in there.
Do a family meeting. Do a family meeting.
There you go, family meeting.
Yes.
It's
Oh
good
my
to have
goodness.
those kind of conversations just to talk about. I think that's something that we've gotten away from. We tend to be more private. We tend to not share what our situation is, especially when we're struggling, right? But to start where we are, do the best we can, review as often as possible, right? When you have a life change or something new has happened, review, and give a call, because that's what I do, is to just review the options, make sure you're covered in the best way you can be, and we'll find something that'll work.
Okay. Well, thank you so much, Juliet, for your time today talking with us about this. This was very, very helpful. Very appreciative.
Thank you so much, Latrice and PIllara. It's been an honor, and I'd be happy to come back and visit again anytime you have some questions.
Yeah, I think you may need to come back. That was a wealth of information, and I'm sure there's probably going to be lots more questions that come from what we talked about today.
Absolutely. Anytime.
All right. Woo-wee. Now, look, we got to dive into trust after that. Wow.
A lot of information today. We're going to talk about trust too now.
Like, oh my goodness, this is going to be a wealth of knowledge for our listeners. So we're going to do our best, y'all, so you guys can, learn about trust as well. So PIllara, she's our expert. She's our in-house expert. So first thing, PIllara, can you remind our listeners what a trust is?
So a trust is basically a contract. Basically, that's what it is. It's a contract, and it's usually a contract with yourself, right? And so the different parts of a trust is you have the person that wants to create the trust, which we call the grantor. And then you have the person that will manage the trust, which is the trustee. And then you're managing it for the benefit of someone, which is the beneficiary. And usually when a trust is created, you are all three of those. You are the person that's creating it, you are the person that's managing it, and it's going to be all done for your benefit. The really cool thing about a trust is that it becomes its own separate entity. And so even though you are creating it and managing it and it's for your benefit, it is outside of you. And so if you become incapacitated in any way, the terms that you have set up in the trust, they will still take care of you. So you always want to name successors, right? So even though it's you to begin with, you would name someone that would manage the trust if you're unable to. You would name someone else that would get the benefit of the trust if you are no longer alive, right? So if you become incapacitated from a physical incapacity, mental incapacity, you're no longer able to handle your affairs on your own, the person that you have named as that successor trustee, they step right in and they will continue the care of you, your everyday maintenance and health and quality of life the same way you would have wanted based on the terms that you have in that trust, right? So it's all for your benefit. Once you pass away, then you get to say, this is what should happen with all of my assets that I'm leaving behind, right? So I want to take care of my kids. I want to take care of my grandkids. I want to take care of an organization. And this is where we kind of come together with what we just talked about with the insurance policies, right? Because you're looking at what are the funds and what are the assets that you are going to put into the trust. And one of the big things that you can do is have a nice insurance policy, right? That will be there to take care of your loved ones in your absence. That money can then fund the trust and you still have control over how that money should be dispersed. And so there's no fear of, I have this $1 million policy, which we all just talked about how to figure that out, right? Different policies. But you're not just giving that money outright. If the money is being left behind, to make sure that it is taking care of your spouse, making sure it is taking care of the kids, making sure education gets paid for and those types of things, you can put those terms within the trust document. And then when the person becomes of a certain age, especially if we're talking about minor children, then you can designate when they will be able to access the income, when they'll be able to access the principal. It gives them a way to learn how to manage the funds without just having a big lump sum dropped in their lap. You can do it over a long-term time. You can do it over their lifetime. It's also a great way to safeguard funds from creditors. We never know what's going to happen, right? Life situations come up and sometimes we just never know. And so you don't know if you're going to get into some type of financial straits. You don't know if you would have an accident, maybe you don't have enough to cover things. You don't know if you're going to get a divorce. You just don't know what can happen. And so if there's ever a possibility that a creditor needs to know now what funds do you have and how to access that, as long as those funds are inside the trust, they are protected. And so that's a really great way to know that your person will still be taken care of without those funds being attacked. So that's just a little kind of overview of what a trust is.
Okay. Is a trust better than a will?
So they're just different. So it's not that one is better than the other because they are completely different documents. A will, like we talked about before, that's a death document. And so it only comes into play upon your death. And the purpose of that is just to manage your assets at your death, right? So it gathers everything, pays final expenses, makes distributions to whoever you've decided you want to give things to, and then it ceases. So it has a finite purpose. You can only nominate a guardian for your children in a will. You can't do that in a trust. And so they're different. They basically do two different things. So with the trust, a trust is not based on, like I said, your life. Normally you set that up while you are alive, but it's considered a living document because it's going to be valid while you are alive, while you are sick, and then after you die. And so they just do two different vehicles. They work well together. And so if you have a trust, I also recommend that you have a will. Like I said, especially if you have minor children, because that's the only way to nominate a guardian for your children. But a will is also, it's kind of your safety net too. So you can say, if there's anything that I did not put into my trust, my will grab it. And then the will says, now put it into the trust. And then it gets managed under the trust, right? But you can also do something with the will. You can use the will within the wording of the will to create a trust. And that's considered a testamentary trust, right? And so testamentary meaning that it only happens upon your death, but it's a different vehicle, right? So you set up your will. It's going to still do the same things that you wanted to do. It's going to manage your assets at your death, but instead of paying out to an individual or to an organization, it's going to pay to your trust. And then that trust is usually set up for children or grandchildren. And then again, you're based back under that same umbrella of what does a trust do and what's the purpose of a trust.
Okay, very good. Very interesting information. So what are some common trust funds?
So as an estate planner, I'm helping you to develop the documents, not necessarily to manage the funds. Okay. And so what you're going to need to manage the funds is a financial advisor, right? And that's the person that's going to help you set up the different trust accounts and to guide you and what's the best funds for you can have. Now, there are several corporations that can assist you with that. And so people don't always name a corporation as the trustee, but you definitely can. And that's a neutral party. And that's always something great to do. But there are companies, though, then your trustee can go to that company, or like I said, you can name that company. So a couple that just comes to mind would be like Edward Jones, Thrivent, Bank Financial, Chase. Lots of these places have a trust department. And so they can help you in figuring out how you want to invest those funds, what's the best avenue, how you're going to manage that. A lot of them depend on how much value is in the trust, right? So some companies it only makes sense if it's a significant asset. So you need to be, on the few millions in order for that trust company, in order to manage you. There are other places, as long as you've got $1,000 or something like that, they can manage you. So it just depends. Sometimes you get to a point where it doesn't make sense to have a trust because most of those companies are going to take between 1 to 1.5% of whatever the value of the trust is. yearly for management. And so there's not a lot in the trust to begin with. What you don't want is you're just paying out all these funds, right? And it completely defeats the point of having the trust left behind for your loved ones in order for them to have the funds. So it may come to a point that it just makes more sense for the trust not to exist anymore, to terminate, and then those funds are paid out directly and held in some different type of account.
Okay, that makes sense. And me working for a fund administration company, we do that a lot, and we do pay. There's a management fee that is paid. There's our fee that is paid, and that is all deducted from those funds. These that we manage. So I think the smallest investment I've seen is $5,000, and even that, I sit and I always laugh because I'm looking at the fees that we are deducting from this, and I'm like, man, his value of his fund is going down and down and down. So we always let the asset manager know, hey, you might want to reach out to him. You need to add some money to this, because those management fees are coming out. Management fees and operation fees are coming out on a month. The management fees come out monthly. Operation fees come out quarterly. So I'm just watching this particular fund, just investor stuff, just go down, down, down. Yeah.
So it's really important in the language in the trust that it's been written in a way that will allow the trust to terminate. Sometimes, unfortunately, there's not language in there that allows it to terminate, and so then there's not a lot that you can do without maybe seeking some court guidance that would allow you to change the terms of the trust. So that's a little bit more of a difficult thing to do. You just can't decide one day, well, I'm just going to terminate the trust. It's not how it works. And so that language needs to be in there that allows the trustee to do that. And if not, you need to have a savvy enough trustee that knows, okay, I need to have a conversation about this, or maybe I need to take this to the court and ask, is it okay for us to change the terms of this for the best interest of the beneficiary?
Absolutely. Can you explain the difference between a trustee and a beneficiary?
Yeah.
I think sometimes people get those confused.
Yeah. So the trustee is the manager. So the trustee does not take anything under the trust. They are entitled to reasonable fees because they are managing. And so it's like a job for them. But they don't have any rights underneath the trust as far as the assets, access to any of those assets for personal use, where the beneficiary is who the trust is set up to benefit. They are the complete opposite. Those trust funds are there for their benefit. They are the ones that are reaping all the reward from whatever the manager, the trustee, is doing. So the trustee has a high duty. He's considered a fiduciary, and fiduciary means that he's held at a very high standard, he or she, very high standard on managing those funds and protecting the funds that are in there. And if they do not do their job diligently the way that they should, they can be held personally liable.
Okay. Oh, that's good to know. Okay. So if you are a homeowner, why should you add your home to a living trust or a revocable trust?
Okay, so living trust, revocable trust, that's pretty much the same thing. So sometimes we can get lost in some of the terminology, but living simply means that it's an ongoing trust. And so once the trust is created, it's ongoing. And so sometimes that's considered living. Revocable, again, that means that, you can change it at any time. And so a lot of times you hear a living revocable trust and so that's just some of the terminology, but that's the same document. It's a really good idea to put your property into the trust, the trust with your property, is that it will avoid probate, right? Which is a key thing that people are usually trying to do. It puts everything under an umbrella. And so especially if you have property in multiple states, if you pass away and you have property in multiple states, each property must be probated in that state. If you do not, but with the trust can own the property, right? And so basically you're changing the title from yourself as an individual. If you are the trustee, then the trustee of whatever the trust is. And so now the trust owns the property and not you. And so guess what? You pass away, doesn't make a difference. That property does not need to go through probate now. Somebody can move into that property the same way that they would. You can sell that property. It does not have to go through that legal court system in order to have good title, because the trust owns the property. And so it eliminates you having to, like I said, open up probate in every state. Property is one of those things that you have to have good title in order to sell. And the only way to get good title, if an individual owns that property, is the probate process. Or if your state has something that's called, like Illinois has a transfer on death instrument, but not every state has that. So we have a transfer on death instrument. Some states have something that's called a ladybird deed. And so it's similar to that. And that in that document, what you are doing is you're saying, okay, I'm going to give this property to an individual as is. And so then they are accepting that property subject to any liens, any mortgage or anything like that. But it's really important that if you have executed that document, it has to be recorded before you pass away. It's usually only for your primary residence. And so there's a lot kind of that goes into the formalities of making sure that you do that. But you can do it, and it will avoid probate as well. But if you don't do anything, in order for real property to have good title, it has to go through that process. And so this is a really great way to avoid that. Like I said, especially if you have multiple properties, because like the transfer and death instrument, it's only for your primary property. So if you have rental properties, you have your home here in Illinois, and then you also have a home in Florida or Arizona, because, you know, the snowbirds, it doesn't work.
Oh, wow. That is good. That is very good information to know. Wow. I hope for all those homeowners are listening, you can avoid probate, put that house at your house to your trust. Mm-hmm. Now, what are the pros and cons to having, are there pros and cons to having a trust?
Well, yeah, I mean, there's lots of pros to having a trust. So if you are someone who is a little bit more private, right? And so you don't want everybody kind of knowing your affairs and what's going on. If a trust is set up correctly, then all of your assets will avoid going through probate altogether. We would need to talk about that in a little bit more detail. And so it is about making sure that it's set up properly, but you can keep everything private. So it's private. You avoid the court process of probate. Things carry on smoothly. What happened today is exactly what can happen tomorrow. There's no glitches and things. There's no waiting to get access to your funds or for things to carry over. And so it's a smooth process. You can have everything under one umbrella, like we just talked about, if you have multiple properties in different places. And so it's one place to manage everything. Mm-hmm. If you do have minor children, or you have children that have special challenges, or you have adult children with special needs, a trust is a great way in order to help manage those funds until they are able to, if they are minors, or if they're never able to. But you can still make sure that you are taking care of them. You can still make sure they have a great quality of life through the terms of the trust, even though they don't directly have access to that money. So it's a great management tool. Cons to a trust, I don't know that I would say there's a lot of cons. Probably the biggest one is that people create a trust, but then they never fund it correctly. So then you have a piece of paper that's worthless. And that completely defeats the point. And so you really need to understand how a trust works in order for it to do the things that you want it to do. So like I said, you can use it to avoid probate, but if it's not done correctly, then it won't avoid probate. Like, you can't have more than $100,000 worth of assets outside of the trust, or guess what? Those assets have to go through probate. So you have to make sure that it's being managed properly, that you have it set up properly, that it's actually funded properly, in order for it to do the things that you want it to do. I guess maybe if I had to pick a big con, I guess with the will, creditors only have a finite amount of time to come forward, right? So they have a window, and this is the window. You have to come forward and you have to say that I am a creditor. If you do not come forward and say that you are a creditor, once that probate case is closed, you're just out of luck. Mm-hmm. With the trust, There is no window.
Oh.
So your creditors really, they kind of have an infinite amount of time they can come forward and say that they are entitled to payment for whatever that happens to be. So as the trustee, that's one of the things that you really want to make sure that you're on top of, because usually within that document, it does say that the trust is responsible for all of your final expenses, right?
Mm-hmm.
And so that means your funeral expenses, that means your illness expenses, that means any debts that you still owe. And so you want to make sure that those things are being taken care of before you begin to pay out and distribute funds, because the last thing you would want to do is to pay out all the money in the trust and terminate the trust, and then a creditor comes forward that has a valid claim and you didn't take care of that creditor, and then they sue you and can show that they did have a valid claim, and you as the fiduciary who had this responsibility to make sure those things were taken care of didn't take care of them.
Wow. So would they sue the fiduciary, or would the fiduciary have to go back to all the family members that they distributed money out and say, hey, y'all got to give me some of that money back. I got to still pay some other bills.
You know, it depends. If this was a negligence on the trustee's part, it may be that they can't go back to the beneficiaries and recoup. So it depends. All that's very specific. And so it's really hard for me to say. And that's why you have to really take this job really serious, right? And so when people are choosing someone to be in these roles, it is really important that you're choosing someone that has enough wherewithal to know that these are the things that I need to do, or to simply know, I don't know all that I need to know, right? A lot of times that's just it. I don't know all that I need to know. And so I need to have enough sense to know that I need to contact a lawyer. I need to contact the CPA. I need to contact a financial advisor. I need to contact all these different people to make sure that I'm getting the right information, to make sure that I'm following this out the best way that I can. There is language usually in the document that says if it's an honest mistake, then no, you may not be responsible for that. And if you've already distributed funds and there's no money there, I mean, the court can't give you what doesn't exist.
Right. Very true. Very true. Oh my goodness. This was so good, PIllara. Some of the questions I had written out, you kind of like overlapped each other. And I'm, how I'm looking at them like, oh, she's already answered that, within this question. So this is very good. And I know going into more detail, maybe we can pick up on the next podcast. We can talk about how a trust works and how to fund a trust. Because like you said, you have people, they open up a trust and do absolutely nothing with it.
Yeah, it's a worthless piece of paper. So I know people will go online, and I'm not against the services. I'm not against access to legal information and things. I'm not against that at all. However, I do feel like when you do that, sometimes you have a false sense of security. And so if things are not executed the right way, or you don't know the right follow through or follow up, then you don't get what you are expecting to get. And so, yes, you can download a trust and write it out the best way that you think you know how, but that might not be correct. And if you haven't funded it the correct way, then it's useless. Or even if you've gone to an attorney and they've written it for you, but again, if it's not funded, it's a useless piece of paper.
Now, you had mentioned no more than $100,000 in assets in the trust. But what if the house is, what if your house is, I don't know, say $300,000? It couldn't be in the trust?
No. You can't have more than $100,000 outside of the trust.
Oh, okay, gotcha. Outside of the trust.
Yeah, so it's important to know. So there are different types of assets, okay? So you have assets that are contractual, like we talked about with Juliet today with the insurance. So that is a contract between the insurance company and the individual that's taken out that policy. So whoever they've named as the beneficiary, the insurance company will pay them out directly, right? So that's an asset that comes outside of what you would consider your assets that's going to go in the trust or go through probate. That's different. Then you have your real property like we talked about. So like a home, land, things like that. You have your tangibles and intangibles. So your tangibles are things like your clothes and your pots and pans and your furniture and all those things that you can touch, your savings account, your checking account, all that stuff, right? So what you're looking at is you're saying, okay, have I named a beneficiary? Have I named a payable on death, a transfer on death, or anything like that? If you have, all those things are considered contractual. That's not under this umbrella that we're looking at. But say your savings account, your checking account, your vehicles, and all that, those types of things.
401k.
Not your 401k.
Oh, not your 401k. Okay.
You usually name someone. So those, all those things only come into play is if you haven't listed a beneficiary at all, because it becomes part of your estate. But if you have someone named, it's not part of your estate.
Okay.
So looking at the things that would be considered part of your estate, and you want to ask yourself, are those things over $100,000? If they are, then the state of Illinois says if you have not made special arrangements for those things, like putting them inside of a trust, they must go through probate. And so that's what I'm saying. If you haven't, and like your real estate, if you have not made special plans for your real property, it must go through probate. Okay. So when people set up a trust and they never change the title of the property into the name of the trust.
Gotcha.
$200,000 sitting in the bank because you've got $100,000 in your savings, you've got $100,000 in your checking, and then so guess what? All that has to go through probate because it's more than that amount. In Illinois, we have something called a small estate affidavit. And so if you have a small estate, it has to be under $100,000. Anything over that, probate. It's probate. So it's really important that things are set up the right way. And so you hear, oh, I've got a trust and I'm good. I avoid probate. Not necessarily. Not necessarily. Yep.
Ooh, this is good. This is good. Oh my goodness. This is a lot of information. PIllara, you really should write a book.
I should write a book. Would you buy it, Latrice?
I would, man. I mean, come on, a nice resource guide, what Black families should know, give them a better in-depth understanding of what they need to put in place while their children are young, doing it while they're young. That's key, No one taught me about life insurance when I first, I just went, I was like, I'm a mom. My baby was 4 when I first got my life insurance policy. So I was like, nah, I need insurance because my mind, I was thinking, God forbid I go out, you walk outside and you get hit by a bus.
Right.
Who's going to take care of my little girl?
Right.
So,
when we think of things like that, when we think about I should get a will or I think about I should get insurance, is when you become responsible for somebody else.
Mm-hmm. Yeah, a whole living, breathing, another little person. Mm-hmm. This was really, really good. Oh my, we got a lot of content to blog about too.
Information.
Yeah, a lot of information. Whew. Yes, guys, and it will be a part 2. We're going to have to do a part 2 with this, how a trust works and how to fund it, because I think there, a lot of people, like you said, they go out there and they create these trusts online and don't fund it. It's a worthless piece of paper.
Yeah.
That's like me typing out, here's the Latrice Carter Trust Fund, and make all this information in it. And I don't do anything with it. I don't open up any accounts, nothing. Right. So I think we definitely need to, that's something that I think next month that we definitely need to touch base on for our community.
Sounds good.
Valuable information. Thank you so much for that. Juliet, thank you so much for your wealth of information. We're probably going to have her come back and just kind of dive into one or two, different policies that our community does. Because especially with borough policies, there's I see a lot of them, a lot of the commercials, because my mom has 3 has that colonel pen policy.
Colonial pen.
Oh, and then there's two others that she has. And I'm like, how many policies do you have? And I'm running around trying to track her policies that she has. And she said, well, I'm only paying $67 a month total. I was like, okay.
Yeah, but it sounds like when we get targeted, it's just like Juliet said, we get targeted for these policies that are teeny tiny, and they're paying a lot of out of pocket for it. And so she may have 3 policies, but it's whether or not she has 3 significant policies. And if she does, that's great. But unfortunately, if she's like most of the people I know, she might have 3 $10,000 policies that she's paying $67 for, which is not good.
Yeah. My cousin died. He had several policies, and when he passed, my brother was trying to work with insurance companies to get them to pay for the funeral. And one of the policies, because it wasn't completed correctly, I don't know if he didn't sign it all. It was like void. It literally voided policy. Yeah. And he ended up, it was so weird because, the family had to come together, try to gather the difference of the money. And his funeral got pushed out even further. And it was really sad because then another policy had lapsed. And so he really, out of the 4 or 5 policies he had, there were only 2. It was only 2. And he was still short. So my family came up with the difference. And because the funeral home was owned by a family member, they like discounted down the casket, and then there was a burial fee to dig the grave. And I was like, are you kidding?
There's a lot of fees that people don't realize. Yeah, there's you had to dig it, to open the site, to close it. It's
like $200. My brother said it was $600 for them to dig it. I was like,
yeah. There's so many fees that people don't realize that exist when that time comes. And, most funeral homes, which makes sense, they're not going to perform any of the services until you can pay for them. Right. Because it's a business like any other business. And so they have to make sure that there are funds to cover all the things that they need to cover, right? Caskets are not cheap. The labor to have the people there to run all the things that need to happen, that's not cheap. So there's so many stages that has to happen. And so there's a lot of money in there. And so, you need to be able to pay that before anything will move forward. And so it's unfortunate that your relative, the service got pushed out and pushed out and pushed out.
And I'm like, you can't keep him up this long. And then a friend of mine, her husband was killed and he had no life insurance. And so she went the cheapest way. She had him cremated. His mother wasn't happy about it, but she was like, nobody else is, nobody was like willing to help, like pay for it. And she was like, I'm not for to tackle that burden. So
maybe we can have a show about that, the different things that you can do at that time. Because I think sometimes people don't realize the different costs and what goes into it. And maybe seeing what your different options are now would make a difference. I know, unfortunately, that there are some in our community that frown on certain things. But I think if you look at what your situation is, what that person actually wants, that will make a huge difference. Sometimes I think we do things out of tradition, and I love traditions. However, having a conversation makes more sense. I just assumed that, like most people assume, that my father would, probably want to be buried. But I've realized I need to have that conversation. Do you want to be buried or do you want to be cremated? Is it okay for you to stay in the state that you're in right now? Or do you have some expectation that we're shipping you back to your home state? Like, what exactly is happening? And I know a lot of people don't like to have those conversations, but it's important to have those conversations. If you have not put yourself and put your family in a position that they can pay for a $20,000 funeral, then a $2,500 cremation may be the best way for you to have the best homecoming that you can have.
Absolutely. 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 My mom, she told us a few years ago, she was like, I want to be shipped home. And that's when I was like, well, I need all your policies to see how much all your policies are, because if your policies don't add up to be able to ship you home, because she wanted a funeral homegoing in Wisconsin, and then she wanted us to ship her back to the South, Mississippi. And I was like, oh, you tripping.
That's a lot.
Yeah. And she said, and I want to be buried next to my mom and daddy. I was like, do you have a plot next to your mom and daddy?
Yeah. So that's a lot, figuring that out. And some people might be like me. I would rather my family have that $20,000 as opposed to using that $20,000 to put me in a hole. And that's just my preference, you know?
Right. I was just like, oh my God. Yeah, we had that hard conversation with our mother. And so I told my brother last year when they relocated her to Mississippi, I said, she gonna stay there. She gonna stay there because that's what she want. You know, she was like, it's time for the good Lord to call her home. She wanted to be buried in Mississippi, and now she's there. I was like, woo. I said, you just saved us some money. I said, now we just got to make sure your policy. So I have a whole folder, and I'm going through her life insurance policy. And, you know, my sister is sending me copies of her policies. I was like, I need to make sure all her T's and I's is crossed, and that, you know, what she's paying in, that this policy is valid.
Right.
And the value.
Right.
Because she gave me some numbers in her head, and I was like, no, I know you don't know this, because my mother has beginning stages of, is progressing in dementia. So I'm like, I know you don't know. So just send me the policy so I can go through it. Because,
unfortunately, a lot of the individuals get that are at home, right? And maybe, you know, thinking about their final days, they get preyed upon on TV during the midday, right? And those commercials can be very misleading. They don't give you the full scope, the full picture. And what they will end up doing sometimes is taking the cash value out of something that's existing and working and transferring it to buy something. Oh, it's all paid up now, you know, and that can work in many cases, but sometimes it doesn't. So, you know, look after your parents. Have the conversations that nobody wants to have, because when you're grieving, that's the worst time to be making these kind of decisions.
Absolutely.
Absolutely. Oh my God. And the fighting among Black families when it comes to a funeral, it's very frustrating.
But that's what PIllara is for.
Yes, you know, I'm making sure my stuff is in order. So she already took care of me. We're working on my daughter now.
That's what I'm trying to do. I'm trying to eliminate the fighting, eliminate the chaos.
Yes. I have another quick question before we go. I'm a published author. My royalties. Do I need to add? What happens with that? I guess
that's your property.
It's my property, so I need to add it to my will, right?
So it's your property. If you want to have anything particular to happen to it, then that needs to be spelled out. Right now, it would just be considered part of your estate. And so if I'm remembering correctly, it would pass to your daughter.
Yeah, okay. Yeah, because now, you know, I have this, I'm getting these books out here to do this thing. And I'm like, oh my God, royalties, God forbid, you know, I'm a little bit haunted, okay? You know, when good Lord called me home, I just want to make sure all my ducks are in order. More and more property. I got to remember it's property. See, okay. Okay, and then life insurance. I can revisit at buying additional policies in 5 years, Juliet? That's correct? Maybe I should just call and have a conversation with you.
Just give a call, have a conversation anytime. You never know, depending on what you're looking for.
Okay,
really
because I am going to
depends
buy a
on-
house, so I want to make sure I that covered somehow. Okay, okay, okay. Thank you, ladies. So appreciate you. Until next time, this is Latrice Carter and PIllara Henderson-Smith with our special guest, Juliet Marie McElwee. Thank you so much for joining today. This is good. I hope you guys took good notes. I'm going to drop all the links on our social media, in our group, as well as it's going to be on a blog post as well. So lots of information. Pick up the phone, give her a call. Pick up the phone, call PIllara too, because some of y'all know y'all need to call PIllara. All right, ladies, have a beautiful weekend and blessed and stay safe.
Thank you, Latrice.
Thank you so much. It was an honor. Thanks.
Thanks to our special guests for joining the show today. Be sure to follow us on your favorite streaming channel so you don't miss a show. We can be heard on Spotify, Apple, iHeartRadio, Spreaker, and YouTube at Sisters Place. Visit our website, www.sistasplace.com, to learn more about us.